We're back here on Public Affairs on Peach. Hope you're having a good Saturday morning. Bobby Capel, Manka Kaur, and Andrew Paulos. She's a financial advisor. He's a CPA. He's got Paulos Consulting. She's got her own wealth management division. All right, let's continue the discussion we were starting before the break. We're talking about preparing them yourself. In certain cases, it can make sense if you do enough research, though. That's what we were just discussing with the mortgage deduction.
Yes.
Give me a horror story of someone who maybe should have had a CPA do it and lost out on a lot of money.
Well, let me give you a good horror story. It's a case I'm representing now. I do a lot of representation, but a lady who came in for representation, she's been fighting the IRS for 4
And when you say representation, you mean you got audited? Or?
Got audited,
Yeah.
you're being audited, or
And
you
you
got
need
audited and now you owe a huge whopping bill to the IRS and you need some assistance,
Yeah.
right,
Okay.
for collections. But she came to me for help. She has been running her own business, handling payroll, handling her own taxes. It's turned into a disaster. She got audited. She owes taxes to the tune of over $550,000, and then she had liens and levies on her bank accounts, business accounts. So
That's ugly,
it's a real ugly situation. She's been fighting the IRS for 4 months on her own. So finally, she decided to get some professional help, and I got the levies lifted in 24 hours. So what she couldn't do in 4 months, I did in a day. But that's the stuff that typically she says, well, the IRS won't call me back. Of course, it's not in their best interest to call you back and just release the levies.
Well, it's like an insurance company. They're never going to give you their best offer first if you have a car accident.
Of course. But, you know, it's back to the point of if you do it on your own, right, it goes back to timely filings and good filings and record keeping. Those are the two essential elements. So if you do it on your own and you don't know what you're doing, you're obviously, A, could be overpaying, because you're missing deductions, and B, if you don't have good record keeping and you kind of like, oh, reading the statistics right of what the media puts out, oh, well, less than 1% of folks get audited. That's probably true.
But for that 1%.
But for the 1%, if you're one of those
tough.
that falls in there, that doesn't feel very good when you get audited, and then you got a nasty whopping bill afterwards.
Is that something you work on with your clients also, on ways to kind of put your money in places where you're not going to end up with a massive audit from the government?
You know, I think that's mainly something that I would defer to a CPA because,
Right.
you know, that's not something that we work with clients on. However, I'd say that, you know, to me, it's really important a lot of times to work with a CPA or an, you know, appropriate party that could help you, whether it's an enrollment agent or a tax attorney, because those guys are on top of the tax code.
Well, let's be honest. One of the big jobs of a wealth manager is finding ways to avoid having to pay taxes legally. That's part of the drill because not everybody knows this stuff. What are some of the ways people can do that in 2017, for example?
Okay, so I think a lot of times, once again, you know, you have to go back to what can you maximize that A, your employer is giving you, B, you know, take a look. I mean, do you qualify?
Let's dig into that for a second.
Okay.
So, for example, if your employer were to offer a 401k, which is a retirement fund that you, correct me if I'm wrong, you can't touch it until you're after you're 65 without a penalty, and then you have to draw at some point,
It's
right?
59.5, and then you can, at that time, you know, take a distribution. Now, I
But
think
that's before taxes, they take that out. So you're not taxing that money on the front end.
you're not,
Right?
yeah,
And
you're
it
not
grows,
being
grows,
taxed.
grows.
Yeah. It keeps growing until it's time for you to take the money out. It's tax deferred.
Okay. And some companies will match.
Yes.
So if you put $1,000 in your 401k, they'll put $1,000 in
Exactly.
Your
And
401k.
so it's you know, free money. You definitely want to make sure that you take advantage of it, and you want to, you know, compounded earnings over the years without having to pay any tax on it really can mean a lot to most individuals. So I think that's a really important piece. And I think a couple of other things a lot of people don't realize, and I think Andrew might be able to shed a little bit more light on it, is, you know, even though the, you know, age limit is 59.5 for you to access your 401k, if you're separating from an employer, say, sooner than that, say at the age of 55, then you could potentially set up systematic, you know, payments that are equal payments and be able to access that money a little bit sooner if you do an early retirement.
Good point that Manka points out. And also, one of the things I just kind of maybe a little off topic, but in relation to 401ks and whatnot, a lot of the housing market's been booming, right? So a lot of folks have been buying houses. What most people oftentimes miss is you can actually, there's a provision in law where you can withdraw $10,000 early before 59.5 from your 401k and not get the early withdrawal penalty. You still have taxes to pay, but you can use that $10,000 as a down payment on a house.
That's right, up to 10,000. Yes,
Yes.
I think we did that.
So,
I
so
remember
there's
for our
different
house.
strategies,
Yeah.
of saving and then
Yep.
putting your money to good use over time, possibly even before the time that it comes.
Because
for
let's be
distribution.
honest, if you don't have to pay taxes on that money when
Yeah.
it's going towards your house, why would you want to? That brings me to something else while we're on houses for a moment here, the homestead exemption
Coming
here
up.
in the state of Georgia. So I did this for the first time this year, and Better Call Harry is the one who turned me on to it. I didn't know anything about it, okay? So there's a plug, Harry. But he was right, so I did it, and he said, you're going to save money on your mortgage.
Yes.
And I looked, and my mortgage ended up, I think, $200 less every single month just for signing a piece of paperwork and doing an email. I didn't have to do anything else. How does that work, and how can people figure it out?
Yeah, the homestead deadline, it's...
What is it, first of all? 'Cause
It's property taxes.
Right.
So effectively, a portion of your property tax bill, the homestead portion, gets reduced if you file timely. So what typically happens is
you just have to do that once
one time, yes,
for life, and or for the life of the mortgage.
as long as you live in that property and
Yeah.
it's your primary residence.
Right.
If you are purchasing investment properties, you don't qualify for homestead.
Okay.
So what typically will happen is this. You'll buy the house, let's just say you purchase a house mid-year. You're going to get picked up for homestead from the seller who sold you the house if they had filed for homestead. So you'll be good for the year that you purchased it, but come January 1st of this year, you've got to file for homestead under your name,
Right.
which the deadline's coming up on April 1st. So if you miss the deadline, you basically are going to see homestead in part of your bill. Relatively speaking, and this is just percentages, but from what I've seen in practice over the years, it's typically somewhere about a 25 to upwards of 40 to 45% savings on your property tax
I
bill.
could not
and
believe
that's why
when I
you're,
saw that.
That's why you're seeing the $200
Yeah, I
reduction.
said, Harry, we're taking you out for dinner. All right, we'll be right back with more discussions on taxes and how to save money after this.